want to speak to fund manager George Godber. He's a founding partner at Matterley Asset Management, and he co-manages their undervalued asset fund that's currently worth some £26.3 million. Joins me in the studio now. George, good to see you.
Morning.
So we were just going through a number of corporate results there, and obviously it's the macroeconomic situation that's really driving markets right now, but some good opportunities to be had as well, right?
Definitely. I think we're in a very tricky situation. I think from a bottom-up perspective, there's a lot of cause for optimism. We've got decent income backing from the market today. Dividend yield on the FTSE circa 4%. That's a premium to gilts, to AAA corporate bonds. Valuation price to earnings is obviously similar to levels to what you saw in the sort of 70s, late 70s, early 80s recession, the 90s recession, 2003. These proved to be opportune moments to invest in the equity market. Against that, you've got an incredibly uncertain outlook in Europe that doesn't seem to be real clarity, or the clarity of the market's open, and that means that we're stuck in this risk on, risk off roundabout that won't get resolved until Europe shows some sort of clarity.
So your approach amidst all of this is a defensive one?
I think more just you have to accept we're in a volatile market and use that volatility where you can to your advantage, and be buying the companies that I have faith and belief in that are the wrong price aggressively when you have the red days, rather than sort of trying to second guess what the next move from the politicians may or may not be.
So where do you see good value right now?
I think on sort of stock-specific levels, I think there's some exceptional value around. I highlight something we've been investing in heavily, like Sainsbury's.
Right.
We try and find companies that are below their tangible replacement cost. So that's to say, can you buy the shares in the stock market today that it would cost you less to replicate that business from scratch? Sainsbury's market cap £5.5 billion, debt of £2 billion, so it costs you £7.5 billion to buy the business. It's got property stated in the report and accounts of £10.5 billion. But if you were to actually try and replace that property today, it probably costs you closer to £14 billion. Business that yields 6%. It's grown its profits every year for the last 5 years.
We're just looking at their year-to-date right now, down almost 20%, aren't they? And I suppose the concern with Sainsbury's and Tesco's, a lot of these types of stores, their competitors, is that they are now being hit by depressed consumer sentiment, aren't they?
Yeah, but that's more than reflected in the valuation, and I think that's why you're getting the shares at sort of near 25-year lows in terms of multiple of book, and that's what I think is at some point the sentiment will change. It's a very defensible business model. Still get 15 million people a week walk through the store. We still need to all buy bread and milk. So I think that's reflected in the valuation, and that's the opportunity I'm being offered. You'd have thought also there's some sort of disconnect between, if you look at Sainsbury's and say where Next is trading, or Kingfisher, that these are businesses that are equally exposed to the UK consumer and trading on relative highs at the moment.
So how do you explain that disconnect?
I find it very well. There is those two businesses are very well run. They've probably got certain things going in their favour in terms of input costs. Cotton prices have come off. You've actually seen huge capacity come out of the high street. Weaker players going bust. That does mean for those that are left standing, especially in the DIY market, it's an easier playing field.
Raw material costs weighing on these companies, is that a consideration for you?
It's something I went and get coffee this morning, and the guy weighed my coffee as he handed it over. It's new company policy that they have to check the amount of milk that's in the coffee. That's how much it's impacting businesses. I think we look at who's benefiting from commodity price falls that we're seeing at the moment. You've seen the oil price come off. We've been looking at what chemical businesses are benefiting as their input costs may fall, and trying to expose ourselves to those people who actually can benefit from that. And
I'm also curious, one stock that you quite like right now, Cairn Energy. So what is behind your rationale there?
Cairn is quite an extraordinary situation. I mean, obviously, if we take a step back, it's one of the biggest success stories in the UK over the last 20 years, probably compounded at greater value for shareholders than almost any other company around. But it stands today to quite a unique situation. It's valued at less than its cash in the bank and the value of its listed stakes, to the tune of £1.5 billion. So the market is implying that the rest of the business is worth negative £1.5 billion. They are selling all but 28% of their stake in Cairn India to Vedanta. That deal is going through the final closing period. It's been approved by the government. At that point, I do expect that there'll be a very significant shareholder return even as much as £2 a share. This company trading today at £2.85.
So this sort of extreme valuation, if you like, completely outweighs concerns about where oil prices might be going and how that might impact on these companies, perhaps there being a slowdown for demand for their services, for their infrastructure.
Yeah, I mean, it's very rare. You know, you look at the oil, you know, we are now starting to see downgrades, you know, creep into some of the majors as, you know, analysts' oil price forecasts are probably too high. So you either got to expose yourself to that, which is the best production growth profiles around, because that will insulate you against the volatile oil price, or, you know, this is a separate situation because the value of the assets is so cheap relative to what their true worth is, that actually I think you can afford to accept the volatility of the oil price.
And just a quick one on where we are with, you like the house building industry as well. Now, you're saying that we've reached a bottom in terms of the housing market transactions here in the UK. So why do you say that?
I think I want to make the distinction between housing price transactions and the house prices. I'm not making a call here on where house prices will go from here. I think we've all got a view on that. But in terms of house price transactions, what we've seen, we're still 50% down from peak. We've still got a population that's growing. We still have demand for housing of around 200,000 a year, and we're building 100,000. So what you're doing is exposing yourself to supply-demand constraint, where the supply is simply not matching demand. People move houses because they need to move jobs, they're either getting divorced, or they simply move because they need bigger space for family reasons. And what we're seeing is quite clearly through the reporting season is that actually the market is better than that is reflected in the newspaper. So we saw Bellway yesterday, Galliford recently reported, and you know, you're seeing...
So you're betting on there being more investment into this industry, and that's going to boost house building.
Well, I do think it's something that the government is looking at very closely. Every pound spent on construction in the UK adds £2.80 to the economy, and crucially, if you think a house that's built in the UK, 95% of the materials are sourced within the UK. So the money that you stimulate that industry actually stays within the economy. So I do think I wouldn't be surprised to see some form of government policy in this area. And they're well-run businesses. They're well capitalised. Certainly, I think it could be a good opportunity.
All right, thanks very much, George Godber, founding partner and fund manager at Matterley Asset Management. Thank you.
Thank you.